buying a house in Germany with zero money. It's one of those ideas that splits people into two groups. Some think it's not possible. Others assume it's something that only works in theory. And honestly, this reaction does make sense. For years, the message has been very clear. You need savings and you need at least 20% equity. But just like the German housing market itself, it's more nuanced than that. In a higher interest environment, banks often adjust how they assess risk. And in that environment, buying without equity doesn't disappear. It becomes a niche option for a very specific type of buyer. So the question becomes, can you buy a house in Germany with zero money? By the way, if you're new here, my name is Ahsan, and on this channel we discuss how to build wealth in Germany. So when people hear zero money, they often imagine something extreme. No savings at all, no costs, or even something illegal or misleading. That's not what we're talking about here. In Germany, buying with zero money means buying with zero equity. In other words, you are financing the purchase entirely through loans. So there are two common versions of this. The first is called 100% financing. In this case, the bank finances the full purchase price of the property, but you will still pay the additional costs like the notary, land transfer tax, and the agent fees out of your pocket. The second is 110% financing. Here, the bank finances not only the purchase price but also those additional 10% costs. This is what people usually mean when they say buying a house in Germany with zero money. Both of these options are legal. One of them is less common, but both come with trade-offs that most people underestimate. To understand why zero equity financing is the exception, you have to understand how banks think. Equity isn't just money, it's a positive signal. When you bring 20% equity into the deal, you're telling the bank that you are willing to take the first loss if something goes wrong. That makes you safer from the bank's perspective. When you bring no equity, the bank takes almost all the risk. And banks don't like risk unless they are compensated for it. That compensation shows up in three places: higher interest rates, stricter approval criteria, and far less tolerance for changes in your life. So when a bank agrees to finance a property without equity, they are not being generous. They are actually making a calculated bet on you based on your income, job stability, and your ability to handle pressure over many years. So how does zero equity financing actually work? If you buy a house in Germany without equity, you almost never do it with just one loan. Instead, the financing is usually split into two parts. The first part is a standard loan. This is a normal mortgage with a fixed interest rate and a fixed monthly payment. Depending on the bank, this loan might cover 80, 90, or even 100% of the purchase price. The second part is what replaces your equity. This is called a subordinated loan. This loan fills the gap between what the main mortgage covers and the total cost of the property. It can be secured in the land register, or it can be an unsecured installment-based loan, which is purely based on your income. Either way, it carries a higher interest rate because in case of a forced sale, this loan gets paid last. That detail matters more than people think. Let's do some real-world calculations. But before we continue, please hit the like button if you're getting value from this video, hit the hype button if you see it, and consider subscribing. Okay, imagine you want to buy a house for 400,000 euros. The additional costs come to around 40,000 euros. That brings your total cost to 440,000 euros. If you had equity, this would be straightforward. At a purchase price of 400,000, you would bring 120,000 in equity, 80,000 euros for the down payment, and 40,000 euros for the additional costs. Without equity, the financing would be quite different. One bank gives you a main loan covering most of the purchase price. A second loan, often from another bank, covers the rest. That second loan has a noticeably higher interest rate because the risk is higher. On paper, this structure makes a purchase possible. In practice, it also means your monthly payment is significantly higher than it would have been with a traditional down payment. For example, in the case of 110% financing, the interest rate on your initial 100% could be about 4.2% per year, compared to a 3.8% if you had brought in 20% down payment. And the subordinated loan to cover the 10% buying cost would have an interest rate 7 or even higher percentage. This is where most people realize that possibly possible and comfortable are two separate things. With a conservative financing structure, monthly payments are manageable. But with full or over-financing, these rise very quickly. In the case of 80% financing at 4% interest and 2% repayment, the monthly payment would be about 1600 euros. At 100% financing, it would be about 2100 euros. And at 110% financing, it would be 2600 euros or even higher. So if you buy a house without equity, you have to pay about 1000 euros more each month, which is roughly 60 to 65% higher monthly payments than with 80% financing. That increase doesn't just affect your bank account, it can even affect your lifestyle. Now, your margin for error becomes even smaller. This means that taking a break from your work or switching jobs feels riskier, and for most first-time owners, an impossibility. Even small disruptions like illness or parental leave matter even more. This doesn't mean zero equity financing is wrong. It means that it demands discipline and, most importantly, stability. If your income is predictable, that trade-off might be acceptable. If it's not, it becomes a source of constant pressure, and for some of you, the bank might not even approve the second loan. Now, everyone just thinks about buying. Very few think seriously about selling. But selling is where zero equity financing can become very dangerous. Imagine you buy a property and 4 years later, your life changes drastically. Health issues or family problems back home. Something that forces you to sell earlier than planned. If you bought with equity, you might lose money on fees, but you usually walk away without debt. If you bought with zero equity, the math might not math anymore. Selling at a loss can leave you with remaining debt even after the house is gone, because a loan is still a loan even without the property. That's not a worst case scenario. It's a realistic one, and that's why the time horizon matters so much. Zero equity financing only works if you can stay long enough for the loan balance to come down. So for whom does this actually work? Let's be very honest. Buying a house with zero equity is not for everyone. In fact, it's not for most people. It tends to work only if several conditions are met at the same time. You need a strong and stable income, ideally two income. You need low existing obligations with a long-term plan to stay, and you need a personality that can tolerate financial pressure without panic. In this setup, the bank replaces equity with your reliability, which becomes the collateral. That's why many banks simply say no to first-time buyers. And people often take that rejection personally. They assume the bank is being unfair or conservative. In reality, banks are legally required to assess whether you can realistically service the loan over time. If they think you cannot, they're not allowed to approve it. That's why people who succeed with zero equity financing don't go to their local bank branch. They work with specialized mortgage brokers who understand which banks are willing to take which risk. Even then, approvals are rare and conditional. So yes, you can buy a house in Germany with zero money, but what you're really doing is using leverage. Leverage amplifies outcomes. If things go well, it can help you get into the market early. If things go wrong, it magnifies the downside. This isn't about clever tricks. It's about trade-offs which you're willing to make. So the question you should ask yourself isn't, can I get approved? It's, would I still feel okay with this if decisions in life didn't go exactly as planned? If you're seriously considering this path, your next step should be to do proper calculation. I have a video here where I break down how much house can you afford in Germany based on many facts, not just what the bank is willing to lend you. And if you're not sure, that's perfectly fine. In this video, I compare buying versus renting in Germany.